Well, stocks are holding on to narrow gains as investors await a response from Iran after the U.S. preemptively struck 3 nuclear facilities in the country over the weekend. According to a note from Michael J. Wilson at Morgan Stanley out this morning, market response is typically limited following a geopolitical strike. But if Iran's National Security Council follows through on its parliament's votes to close the Strait of Hormuz, the oil prices, they could spike. Joining me now in studio for the show, we've got Jay Woods, Freedom Capital Markets Chief Global Strategist. And for more on geopolitics, we've got Russ Mould, who is the AJ Bell Investment Director. Great to have you both here with us today. Jay, thanks for joining us throughout the show here. As we continue to evaluate some of what we're seeing in the early market reaction, of course, we were seeing this play out in the futures over the weekend after the U.S. struck some of the nuclear facilities in Iran. And then now we're seeing some of the early market action here on the day. Jay, just want to get your evaluation.
Yeah, a little surprised that we're shaking this off. This market continues to climb this wall of worry. And after watching the futures open and seeing oil spike almost 5%, I was flipping back and forth from Phillies Mets to check the futures all night. Waking up to see us kind of calming, and now 9 of 11 sectors up for the year, all 11 up for the day. A little head scratching, but kind of a relief. We're still waiting to see what the reaction is out of Iran, but for the market to shrug this off, I'll be honest, it's a little surprising.
From head scratching into strategy, Russ, I wonder what you're kind of sifting through in terms of the data to really inform what that strategy looks like on today's activity, and then even further looking out into the future if we were to see a prolonged type of conflict and events to play out.
Yeah, I think that's what a lot of people are wondering about, is if we did get a sustained increase or widespread conflict and there were to be, say, escalations, which could lead to a sustained spike in oil, that would be perhaps when the worries about inflation would resurface, starting to put perhaps some pressure on consumer wallets and purses, particularly through the petrol forecourts and energy bills. Again, I think perhaps one of the reasons why Jay and I are pleasantly surprised is that we're not seeing that immediate oil spike. So I guess the big worry would be if we got that later. The nightmare scenario would be a return to the 1970s when you saw 2 big oil price spikes, galloping inflation and interest rates shooting higher. I guess one big difference between now and then is that America is way more self-sufficient in oil and hydrocarbons than it was then. And another is that relations with Saudi Arabia seem to be an awful lot better than they were then. So there are some potential similarities and echoes, but some big differences as well.
Just to follow up on that, and there is the question internally here as we've been evaluating here at Yahoo Finance is whether or not there is just so much of the optimism that investors are really trying to latch onto right now that even when there are very present risks, is there more of kind of this melt up reality that we might see play up regardless? Russ, I'll go to you on that first.
It certainly, if you're a bear, you're having a very, very difficult time of it right now. I think if we'd started the year and you said that we'd walked into some fairly spiky tariff and trade discussions between the world's largest economy and many of its trading partners with just one deal done so far, not 200, and we'd walked into ongoing conflict in Eastern Europe and escalation in the Middle East, I think most people would have been extremely pleasantly surprised to see equity markets where they are. And perhaps less surprised to see gold where it is, but equally pretty stunned that oil perhaps hadn't done more.
Jay, want to pose the same question to you, get your reaction.
Yeah, thank God I'm a technical analyst first and not listening to the fundamental news, because the fundamental news makes you want to bury your head in the sand, and it gets people asking me these questions all the time. Why do we continue to go up? Well, we're not really going up, we're going sideways, we're congesting here. We do have some deadlines. We have the tariff 90-day down the road, remember that? One deal done, as Russ said. We were supposed to have 90 deals in 90 days. That comes to us July 9th. This uncertainty is still there. We had the Fed meet last week, and guess what? The S&P 500 was down 1 point on the day, where the Fed kicked the can down the road to the September meeting for a possible cut, and a lot of dissension from the ranks. So right now, I look for where the leadership is, and that's starting to come back in some of these Mag 7 names, these large cap stocks. Technology is doing well. This is good for cyber. We've seen the defense stocks in the industrial sector do well. So there are pockets of strength, and the pockets right now are some of those large caps that are going to keep this market up. And the breadth overall is pretty solid too. So it is head scratching, but the trends continue to be slowly, steadily climbing up. The dips have been bought. We didn't even get a dip to buy this time, and that's what's surprising to me right now.
You know, it's really interesting, especially the typical flow into the defensive sector, as you were mentioning, Jay, based on what we're seeing on some of those flows, on some of the technical indicators and the data. Are we seeing that play out all over again?
We are seeing, this is something new. This isn't anything I can compare to. I wanted to compare this to Ukraine and Russia, and we get that knee-jerk reaction, which looked like it was about to happen, where we sell off for 2 to 3 weeks. Energy spikes. Energy is kind of stable right now. We're seeing some small breakouts in like Oxy's and Baker Hughes and some of these names, but no, there is no panic. There's no fear in this market where it was washed out with sentiment levels at record, historically record lows just a few months ago with this tariff trade. Right now, it's on the verge of a breakout and a FOMO trade if things continue on this path. We'll see.
Russ, assuming tensions start to cool and we do see hopefully some negotiation come to the front, what next after that? Because we still are pushing up, as you mentioned a moment ago, against this deadline for tariffs and the pause expiry there. Are we going to essentially expect that many of these deals or negotiations are just going to get further extended in terms of a deadline that could be pushed back, whether another 45 or another 90 days? What are your anticipations there, and how do investors trade on that?
Yeah, looking at that here from the UK perspective, we're seeing President Trump teaming take still quite a hard line with regard to that 9th of July deadline, but Treasury Secretary Bessent take a bit of a soft one, arguing that if any nation was arguing good faith, they could get some extra time. So if I was one of those nations, I'd make sure I was in front of Treasury Secretary Bessent and his team saying, I'm negotiating in good faith and buying myself that extra time. So we may get some delays. I believe also there still is that Court of Appeal decision coming up on the 31st of July about whether President Trump legally overreached himself with the tariff and the executive order. So that's perhaps another thing for markets to worry about. And we have the big, beautiful bill rumbling around in the background where you still have a lot of investors on this side of the Atlantic fixated on the American sovereign debt and how that's continuing to gallop higher even before the bill, let alone after it. So there are still plenty of things for bears to get their teeth into, but at the moment, they're not getting any joy out of the share prices.